Today, as you all know, we have a special guest speaker today, Mr. Tom McClurg, CEO AICP London. Internal control plays a very important part in risk management, and internal control has a pivotal role in detecting and preventing fraud and protecting organization resources, both physical and intangible. So, I'd like to briefly introduce Mr. Tom. Mr. Tom is the Chief Executive Officer of Association of Internal Control Practitioners, London. His career spans industrial finance, banking, procurement, writing, consultancy, and training. He has served on various committees, including Strategic Planning Committee of a major bank, and also headed major administrative operations in a key subsidiary of the bank. An internal control professional gained from experiences in Europe and with US-based institutions. Mr. Tom brings his extensive knowledge of professionalism practice in internal control, risk management, corporate governance, supply chain management, and training to AICP. AICP is currently providing 2 programs, Certified Risk Internal Control Professional and Certified Procurement and Supply Chain Professional programs. It can be done both by direct entry and examination mode. So I would just start the session. Over to you, Mr. Tom.
Good morning, Dr. Rakesh. Good morning, everyone. Good morning, ladies and gentlemen. Internal control, well, it's probably a little bit different to what you're studying at the moment, but I think you'll find at the end of the program that risk management, internal control, governance, all blends into one. And that's the picture I'm going to try and paint over the next hour or so. We have one slide there which says the pathway to professional standards in business. That is a kind of strap line which I use in the presentations I give. And I believe that to be correct. It is the pathway to professional standards in business. And we'll try and bring that story out. We have about an hour. I'm going to try and, put it crudely, cram in as much as I possibly can in that hour. And then I'll be delighted to take some questions. So, internal control. What's meant by internal control? That's a question that arises frequently. And people say to me, well, you mean risk management? I say, no, I don't mean risk management. I mean internal control. So it's a very difficult one. The knowledge of internal control is a management competency. If they don't know how to do it, they should learn very, very quickly. So let me just try and explain what is meant by internal control. We have a few words on the slides that I'm going to expand on as I go along. But internal control is the systems and procedures that are put in place by management to ensure economic, efficient, effective, and reasonable operations consistent with the organization's objectives. Objectives, as you'll see in a moment, will become very important in terms of internal control. It's a method or approach that minimizes or eliminates risk. It serves, as internal audit would say, as the first line of defense and safeguarding assets and preventing most fraud. It helps to ensure that a process or procedure is carried out as management intended. Historically, back mid-90s, well before the beginning of this century, internal controls were the rules and procedures implemented by business to ensure the integrity of accounting and finance information. Today, internal control goes far beyond the traditional internal accounting controls. It has become a fundamental business management process, entrenched and well-established business management techniques and practices. It's not rocket science. Let me assure you now, it is common sense, business common sense. It's an integral part of managing a disciplined and controlled business, and it affects every aspect of an organization, as we'll find out. It's a combination of the plans, the activities, the attitudes, policies, systems, resources, the efforts of people working together to identify, manage, and monitor risk. So a very, very important aspect of business, and the people responsible for this, their roles and responsibilities, the highest level of responsibility rests with the board of directors or the board of governors or perhaps the CEO. These are the people who are responsible for the strategic direction of the business and the obligations relating to accountability. This responsibility consists of creating corporate policy, organizing, planning, controlling, and directing an organization's resources in order to achieve the agreed objectives. Again, the word objectives have crept into the picture. It stands to reason they have a responsibility to promote an internal controlled environment and culture that motivates people to comply with internal control and risk management strategies and policies. In effect, all employees at whatever level should comply with the company's policies, plans, practices, procedures, guidelines, specifications, regulatory requirements. It can become a nest of vipers. So it's important that people understand just what internal control is about and who is responsible. Responsibility starts at the top. Right, let's find the next slide. We'd say we're fine with all this internal control business. Why do businesses fail? Difficult to actually come up with a solution to that. But let me tell you from my experience and my research and a lot of people I've spoken to over the years, while internal control is an integral part of good management, it's the dysfunctional side of internal controls and common operational weaknesses. These have been cited as many of the key reasons why most corporate failures take place. We have another huge company in the UK with 14,000 employees about to go bust. Yet that company's been going since 1800 and whatever. So we can see that internal controls is lacking in certain areas as risk management. So what have we got? We got unclear policy and strategy. We have unclear goals and objectives. It's on the screen here, so I won't read them all. Lack of business knowledge of the business. Well, now what we find is that people bring in management from all directions when they appear to be in trouble. And those management don't really know what businesses they are dealing with. They come up with business models which people don't understand. And then after a few months, they think, wow, where do I go from here? And that's another problem. Poor communications. What can I say about communications? Questionable ethical standards. The ethical standards displayed in some large, very large UK businesses recently leave a lot to be desired. Responsibilities are not defined. I'll come back on that point. Inadequate systems a lot of these big banks and large companies, they have legacy systems while they're trying to build new ones, and the new ones fail because there's no effective control of the project in terms of internal control or managing the risks. Big problem. Lack of accountability. That is one of the key area in my point. So I'm going to talk about that separately in a moment, as I am about segregation of duties. Behavioral issues of management others, weaknesses occur when people take their eye off the ball. It really does cause problems. So we're going to look at these areas in detail in a moment. I want to go on to a word I emphasize on a number of occasions, goals and objectives. Goals and objectives are the products of the planning process. When the business sits down or the director sits down to plan the business, they have goals and objectives. Now, many businesses set goals and objectives, but they don't analyze the risks of what the road will bring up, or how those risks are going to be managed. So that's a little bit of a tough one for some people. But goals are the long-term aims that the organization wants to accomplish. Together, they describe what an organization expects to accomplish over a predetermined period. As I say, they are a product of the planning process, unnecessary for coordinating efforts within the organization. If you have no plans, no objectives, no goals, you're not going to go anywhere. Objectives can differ from company to company. It could be they want to increase profitability, standing in the marketplace, enhance technical performance, increase the market share. Most companies do. Some other companies, depending on the business they're in, they're going to want to make sure they're compliant with the laws, the governance, and ethical values that they need to display to the public and the shareholders. Therefore, in order to have effective internal controls and to manage risk, the organization needs to first to determine its objectives and to identify and assess the risks that threaten the achievement of those objectives. Fundamental aspect of internal control in business management. As I said in the slide, achieving the organization's objectives is inextricably linked to internal controls. And if it's linked to internal controls, it's linked to risk management. Now, I touched earlier on one of the weaknesses in business: authority, responsibility, and accountability. Let me just give you an example. I try not to take up too much of the time because we've got a little bit of the program to go. Accountability. That's what the internal control is about. The general theme of authority and responsibility is that transactions and other significant events should be authorized and executed only by persons acting within the scope of their authority. This area is so often misunderstood. To achieve an organization's objectives, management assigns the authority and responsibility of the key roles within the business. This includes responsibility for the development and monitoring of internal controls. I say this includes, it should include. In many cases, it doesn't. And this is where risk management can play a huge part in the internal control aspect. There, responsibility, authority, accountability, it should be well communicated, it should be written down. If you have authority to spend thousands of rupees or pounds, that's got to be documented. It's got to be documented in terms of the of what the people can do. So clearly defined, clearly communicated, linked to individual performance. Each manager held accountable for achieving the objectives assigned to them. But I want to clarify this. What is meant by responsibility, authority, and accountability? Authority is the power to make certain decisions and to perform certain tasks within defined limits. Responsibility is the duty to perform certain tasks. Accountability is the obligation to answer for the performance of responsibilities. Therefore, whether it's people or a group of people, they must be provided with authority and responsibility to be held accountable. The extent to which people recognize that they will be held account influences their decisions and actions. It should. I'll give you an example where it doesn't in a moment. It follows that people who are accountable for achieving objectives should also be accountable for the effectiveness of controls that support the achievement of objectives. Now, I did an article on LinkedIn a few days ago regarding the problems we have with government procurement. Government procurement, because of we're all suffering from the COVID-19 environment. The government procurement people, I'm just going to plug this computer in. Government procurement people gave a contract to an investment company to supply £258 million worth of personal protection equipment. £150,000 of that was made up of masks for nurses and doctors and such people. They were no good. They weren't up to standard. Now, £150 million was wasted, totally wasted. I searched high and low to find out who was accountable for the purchase. There was no way I was ever going to find out who in the British government wasted £150 million. It's just another example of the problem we have. I understand that in emergencies, controls can go out the window, but not £150 million worth. We could have built another couple of hospitals with that kind of money, but this is how we waste money because there are no controls. That's life. So let's carry on. Ethics and integrity. This is one of the key aspects of business. And this is how myself and my fellow directors built this particular company, the AICP. We built it on the basis of integrity. Think about it. If you're walking over this rickety old bridge and it's swaying in the wind, you might question its structural integrity in the same way you can question the structural integrity of an organization. Ethical values and integrity are not only essential values in business, they are key elements that contribute to the effective control environment. Now, you'll hear me mention control environment, and I'm going to come back to that because that's another critical area. Ethics and integrity, in my view, are the standards of behavior that form the basis for employee conduct. They should be established, communicated, and practiced throughout the organization. Now, you may say, what's all this got to do with internal control? Well, internal control, as I said at the outset, is part of business management, and management have got to control their operations. So ethical values should be based on what is right. What is right may go beyond what is legally required. And there's a balance that has to be achieved. And how you achieve that balance That's down to your own moral code. Organizations' ethical code, assuming they have one, should include the values and principles to which management and employees aspire. They guide, or they should guide, the behavior of people in relation to the responsibilities and decision-making. Integrity is defined as the quality of being honest and having strong moral principles. It means a person has a moral compass that doesn't waver unless they are a dishonest and moral scoundrel. And we meet lots of those people in life. It is for management to lead by example and demonstrate the organization's values, philosophy, operating style. And an important element for management is to make sure the value of the organization are communicated. The ethical values or poor ethical standards can destroy a business, and all the internal controls in the world will never bring it back. Just thinking on terms of, not every company has a set of standards or a code, but the majority that have, they may be pushed away in their drawer somewhere, but most of them do. And most companies will have a reasonable standard of ethical standards and moral standards there. But it's a management who must be focused, and they must subscribe to creating a culture of integrity and ethical behavior, because that leads to proper conduct and effective governance of the business. Training and education, another aspect, key aspect of internal control, needs to be focused on making values and principles a part of everyday work practices. This ensures the value of the organization with respect not to internal controls necessarily, but to risk management, and ensures the elements of risk management and control are communicated from the top as key values to the business. So ethics and integrity are critical. Now, you may have heard these expressions: segregation of duties, separation of duties. It's one of the key areas for fraud, embezzlement, unless it happens. In procurement, it is frightening not to have segregation of duties. If you're a cashier in a company, it's frightening if there's no separation of duties, because leaving one person in charge of key process. They never take any holidays, very rarely take a holiday. That is if they're up to something in terms of corruption. But it's never easy to separate the duties, but it must be done. There are several mechanisms that can help enforce separation or segregation. And in terms of procurement, which I know a little bit about, the person who requisitions a purchase should not be the person who approves the purchase. Whoever approves a purchase should not be in control of authorizing payment of the supplier's invoice. Imagine. A requirement for 2 authorized signatures and all checks or bank transfers. That's quite a common requirement there. But these are controls, and controls are needed. I myself personally have had no experience, or very little experience in segregation of duties, because one of my roles was running a huge service department, and in that service department, it included not hundreds of millions, but millions of pounds of company vehicles. And I approved the purchase of those vehicles. I paid the bill when the invoice come in, and I asked myself afterwards, why do they let me do that? I could have had 20, 30 new cars for sale on my drive if I could fit them on. Segregation of duty is something you must look at very carefully from a risk management perspective. Now, policy and procedures, I think I've got coming up now. To understand internal control better, it's important to understand what is meant by policies and procedures. Again, controls. A policy is a measured system of principles to guide decisions and achieve clear outcomes. It's a statement of intent, implemented as a procedure or practice. The policy refers to the specific rules an organization passes on to its employees for completing different tasks and responding to different situations. So procedures are the rules for completing tasks that appear in policies. A procedure dependent upon a policy differs in that it describes the steps an employee needs to take in detail. So again, it's very, very important to understand this aspect of internal control. Procedures prescribe the underlying methods and processes all employees rely on to do the job. They provide specific direction to help form the basis for everyday decisions. Without this understanding, conflict can occur and poor decisions can be made. Part and parcel of everyday business. I did say at the outset, it's not rocket science, it's common sense, but not everywhere applies common sense. Unlike us, of course. Now, I'm thinking in terms of how I can put this over in the best possible way. Operations management, I'm talking about the day-to-day business operations, the activities of the business and employees engage in for the purpose of generating a profit and increasing the value of the business as a going concern. Operations also refers to the management of business practices in order to create the highest level of efficiency possible within the business. And this involves utilizing all resources, staff, materials, equipment, production techniques, technology to best effect. It's an area of operations where most risks are found and managed. You will know what I'm going to say next. Operational risk is the risk of loss resulting from inadequate or failed internal processes, people, and systems, or from external events. So as risk managers, you're going to see this frequently in terms of your assessment of precisely what is happening in the business. Our internal audit, oversight people, audit committees, it's an interesting fact that internal auditors, I have dealt with internal auditors for many, many years. My first thing I did was to try and form relationships with these people, because they can really be supportive. They can be very helpful in risk management, in internal control assessments and that kind of thing. And they can come up with things that you may never have thought of, and none of us are perfect. But since internal audits must remain independent and objective in their role, the internal audit unit does not have any responsibility at all for establishing or maintaining internal controls. Now, there may be companies where they do have, but the majority of companies, the ruling of the Chartered Institute of Internal Auditors, my understanding is that internal auditors, professional internal auditors, must remain independent. So what would they do? They would periodically assess the internal control system. They identify and evaluate controls to ensure they're working in the most economic, effective, and efficient manner. They would report findings and conclusions to the audit committee or to the CEO, whoever they report to, and they'd make recommendations for improvement. Now, the important thing here is not reporting that. The important thing is that those recommendations are followed up. Now, it doesn't matter if the manager at the end of the day decides, well, no, I don't want to do that. I'm quite happy with that, with what is happening. At least it has been followed up, and the manager has made the decision. So they provide assurance or not, based on their evaluation of the internal control system across the organization as a whole. That is what should happen. But we know internal audit will pop in today and you might not see them for 12, 18 months. Or alternatively, on a contract I was dealing with in Bahrain last December, there was an audit of the procurement department every 3 months. I just could not believe it. But so with all these things falling into place, with all these important things, the importance of controls, how do we go about bringing it all together? Now, again, I said it's common sense. It's not rocket science. So I think I can turn to what a company is known as the Committee of Sponsoring Organizations of the Treadway Commission, commonly known as COSO or COSO, a joint initiative, 5 private sector organizations, all American, which, in my view, it always makes me wonder why there are no other countries involved in bringing this together. Every organization is different. However, there are some essentials which transcend the difference in types and styles of business. And whenever I may think of this COSO integrated framework, believe me, it does work. It does work. It's very sophisticated. I think the various manuals run into literally thousands of pages. I don't know who's read it, but it certainly does work. Let me say now, it's not necessary to use the framework, but the COSO model does provide some certainty that a developed system follows the organization's rules and procedures. So it's a structure, it provides a structure that's manageable, it's maintainable, and it's flexible. Just as a point on COSO, when the American government introduced the Sarbanes-Oxley Act, which no doubt you're all aware of, in 2002, the Act says, this is what we expect. They didn't tell the businesses how to achieve those expectations, didn't tell them what to do. So the businesses around the world turned to this COSO integrated framework. And they used that to actually make their business SOX, Sarbanes-Oxley, SOX compliant. A bit more about that. The framework is, well, again, they've been running with this kind of cube thing. They present their framework in the form of a cube, like on the screen here. The 3 categories into which an organization's objectives can be classified: operations, reporting, and compliance. They're representative in the strategic columns labeled on the cube. control environment, risk assessment. There are 5 components, by the way. We'll talk about those 5 components in more detail in a moment. 5 components of internal control are represented in the face of the cube. Now, there's more than 5 there, but let me tell you, there are 5 primary considerations. Control environment, risk assessment, control activities, information and communication, and monitoring activities. And we're going to spend a little bit of time on each of those activities. For an internal control system to be effective, again, you don't have to use COSO, but it does work. For a control system to be effective, these components must be implemented, operating together in an integrated manner. They're the 5 components of internal control that are required of the organization to be reasonably sure objectives will be achieved. I said there's lots of pages to COSO, if you'd like to read them, but these 5 components are currently underpinned by 17 principles, and these principles support the effective design, implementation, and operation of these key components. Now, I think only last year, COSO have changed this great cube to something like a donut with a hole in it, and they've increased the number of principles to 21. I don't know why. I looked at it, it doesn't seem to add a great deal of value, but that's life and that's how things go. COSO key components, I just wanted to touch on those. The control environment, the risk assessment, control activities, information and monitoring. It's just another aspect that this is not a waste in any shape for a company to go down this COSO road. A basic understanding of how it works is well worth taking on. But there's a bit of a little, not a problem, an explanation, let me call it. COSO describes internal controls as I'm going to read this, a process affected by an entity's board of directors, management, and other personnel designed to provide reasonable assurance regarding the achievement of objectives in the following categories. 3 main categories: effectiveness and efficiency of operations, reliability of reporting, compliance with applicable laws and regulations. Now, this definition, it throws up certain concepts. Comes up firstly, internal control is a process. It's a means to an end. It's not an end in itself. Internal control is influenced by people, not merely policy manuals and forms. People at every level in an organization. There's another company that back in '95 produced a very succinct 30-odd page document on internal control. And those 30-odd pages, times have changed, of course, but those 30-odd pages probably sum up the whole internal control structure, like COSO, but as I say, in 30 pages, not 3,000. I'm detracting. Internal control, you read that definition, internal control can be expected to provide only reasonable assurance, not absolute assurance that the organization's objectives will be met. So what do they mean by reasonable assurance? Reasonable assurance is a high level of confidence that the objectives will be achieved. High level of confidence. Well, you can't ask for more than that from a process. Absolute assurance is not possible, even though all the due care and diligence in the world is exercised. Why? You know the answer to that one, because the likelihood of achieving objectives is affected by limitations inherent in all control systems and those kind of activities. What do those limitations include? Human error. Human error. Employees may misunderstand the instructions issued and make errors in the operation. Errors also stem from new technology, complexity of computerized information systems. Collusion between two or more individuals can result in internal control failures, and we have seen over the years some serious levels of collusion. Collusion can be defined as an effort among employees to defraud a business of cash, inventory, or other assets. Individuals acting collectively can alter financial data or other information in a way that cannot always be identified by an internal control system. Breakdowns, resource limitations, actions of competitors, shift in government policy, or economic conditions beyond management's control. Management can override the prescribed policies or procedures. We just discussed policy procedures a moment ago. They can override those for prohibitive purposes with the intent of personal gain. I just want to make a point here. Override should not be confused with management intervention. Management may have to depart from the prescribed policies or procedures for legitimate purposes. Finally, the management base their judgment on information at hand. What else can they do? They have information, they're going to look at it, they're going to assume it's correct, and they're going to make a judgment. The information may be inaccurate, or the judgment may be faulty. So I think you'll probably reach the conclusion there's no such thing as a perfect internal control system. You're correct. It's not. Yet control is an important component of business success. The controls, said earlier, are derived from the plans, the methods, the techniques and procedures used to meet business goals and objectives, and to ensure the safety and security of its operations. So reasonable assurance is, and we missed a slide on that one, is what can I say? If you follow the procedures correctly, you check the risks correctly, then the chances are objectives, whether those are strategic objectives or local objectives, will be achieved. Right, we're going to go back onto the control environment. This is one of the first element of the 5 points I mentioned earlier, the 5 COSO points. You see from the little triangle, control environment is at the base. Control environment. Without the control environment, the other controls are of absolutely no value whatsoever. Because the control environment, as I'm going to explain, is key. You may have or may not have heard the expression "tone at the top." It's a common expression used in describing the controlled environment. What they mean is, it's the tone. The tone is the attitude, the words and deeds of an organization's board of directors and chief executive officer. The words that determine the organization's values, culture, and the behavior and actions of individuals. It's through those decisions and actions the tone is set. This makes the control environment the foundation for an effective internal control system. It provides the discipline and structure to help an organization to achieve its objectives. It represents the foundation, as I say, of all controls that exist. It characterizes the management style, corporate culture, values, philosophy, operating style, organizational structure, human resources, policies, and procedures deployed by the boss, the chief executive. Tone at the top also includes creating clear roles, responsibilities, and accountabilities with regard to internal control and risk management. So, vitally important. Risk assessment. What can I say about risk assessment? This is your expertise, ladies and gentlemen. I can say is all organizations faces challenging natural, political, socio-economic, cultural impacts that make their operating environment uncertain. These impacts may have an effect on the extent to which objectives can be met. The effects these impacts have on the organization objectives is known as risk. Common definition of risk, and you will have many. I have one here. The probability of threat of damage, injury, liability, loss, or any other negative occurrence that is caused by external or internal events and which may be avoided through preemptive action. In more simple terms, risk is any negative event that prevents the achievement of a goal or objective. I'm not going to say much more on this topic other than managing risks helps the organization become more efficient and effective by improving forward planning and critical thinking and enabling better informed decision making. You might come to a conclusion that internal control and risk management are very closely related. Control activities. This does confuse a number of people, control activities. But the control activities are nothing more than the policies, the procedures, the actions, and other mechanisms that enforce management's directives and address related risks. They're common business management processes. They're essential for proper stewardship and accountability of resources and for achieving goals and objectives. They're an integral part of each business process rather than as a separate system. Give you a few examples of control activity. Authorization. Controls are designed to help assure all transactions are within the limits established by the organization's policy. Review and approval. Designed to help ensure that transactions have been reviewed for accuracy and compliance. Verification. Control activities that include a variety of computer and manual controls designed to provide reasonable assurance that all financial and asset information has been completed satisfactorily. Physical security over assets. You could go on and on, but you'll find different control activities within different businesses. But in effect, they are the activities set up to help manage the business. Do not be confused by them. They are very straightforward, but they will differ. They will differ. Let's see where we are. In these activities, again, which people become rather confused about, is the two different types of control. Preventative controls designed to discourage errors of anomalies. Different controls, they can be used to counter the risks that threaten the organization's success. And this is why they're grouped into two categories: preventative, I get that word right, preventative and detective controls. Both types of controls are essential for an effective internal control system. very, very important. The preventative controls are designed to discourage errors or anomalies. So development of these controls would involve predicting potential problems before they occur and applying ways to avoid them. I see no difficulty in that kind of explanation. But bear in mind, when you're looking at aspects of this, excessive use of preventative controls, they can impede productivity. Common sense has got to prevail always. The detective controls, well, they can explain themselves. They occur intermittently. They're designed to find errors after they have occurred. They serve as part of a checks and balances system and to determine how efficiently the organization's policies are being applied. Information and communication. I have found that information and communication is the lifeblood of the organization. Quality information, information that's appropriate, current, complete, accurate, accessible, and provided on a timely basis is absolute must. Management must have that information. Therefore, for control to be effective, people need an open flow of timely information from inside and outside the business. It's vital for an organization to achieve its objectives. It enables management and staff to fulfill their objectives effectively and efficiently, including in the sphere of internal control. So what can I say on that? It's a role of the IT professionals and the operations managers, both, to make sure information systems are functioning correctly and the information is secure and there are no authorized breaches. An example of poor information. I worked for a major bank at one time. And I was asked to look at major activities, major expenditure running into many millions of pounds. So I said to we had a guy in the office, an IT guy, he would deal with all the IT inquiries. So I said to him, can you run me a report on the expenditure on, I think it was temporary staff. I said, this amount of money going out, running into £4 or £5 million or something like that on temporary staff. And I'd like to know where this money is going. No. They would have to write a special program to get the information out, and that would take 3 weeks. This is why information is vitally important to managing the business. If you think about it, information communicated to the CEO or to the oversight body, the internal audit or audit committee, or whatever committee it may be, is going to include significant matters relating to risks, changes, or issues that impact the organization. Management and the board of directors, they need the information to fulfill their roles with regard to achieving the organization's objectives. So you begin to see where internal control is very much related to the whole aspect of corporate governance in the same way that managing the risk is. Because internal control is there to help mitigate and manage the risk. There's not much more I can say on that, really. It's just fundamentally important. I would just add one thing. The most important element is to ensure, in terms of communication, is to ensure the values of the organization with respect to risk management and internal control are communicated from the top as the key values of the organization. Believe me, they are the key values of the organization. 8. Monitoring. Monitoring is the 5th element of the COSO model. Once risks have been identified, recorded, analyzed, and the agreed treatments, i.e. controls, have been implemented, an appropriate monitoring and reporting system needs to be established to provide assurance that the treatment has been effective and helps to control the risk. When changes occur, new processes, new systems, staff changes, changes in job responsibilities, reorganization of a department or business subsidiary, major changes in personnel, this often affects the control activities that were designed and currently in place to prevent or reduce risk. That is a danger zone, because when the changes are made, the monitoring needs to be in place to make sure those changes are considered in any changes that needs to be made to the internal control. Now, monitoring, just keep in mind the system. It's a loop, and you've got to keep monitoring. It doesn't mean to say you've got to look at the same thing every day, but you've got your most important areas that needs to be looked at. I was just going to put a comment here on what I describe as a baseline for monitoring. I had a telephone call from Malaysia 3-4 weeks ago. Guy there who's a member of my organization, he took a new job out there as internal control manager for a fair-sized company. And he said, he phoned me up in panic and he said, hey, the executive want a position paper on the internal control. How's it doing? He said, I haven't got a clue how to arrive at that position. And I said, well, you must know where they're positioned now. He said, no, I don't. So the monitoring I don't think it ever happened, because they brought the guy in to actually put a new system into place. So I said, well, you need a baseline. You need to know where that position of your internal control or risk management practices are now. So to cut a long story short, I gave him the tools. But just to confirm on that, baseline is the current state of the internal control system at a specific point in time. This represents the difference between the design of the internal control system and the condition of the internal control system now. Baseline is so useful. It can be used as criteria in evaluating the internal control system. Changes can be made as appropriate. Management either changes the design or they address the objectives in a different way, and change the systems and controls that are in place. But if you know where you're positioned at any one time, you've got a better opportunity of doing a full management report on the system. Okay. Documentation. Documentation is not one of the 5 components of the COSO framework, yet it's a necessary part of an effective internal control system. I put just a couple of words on the slide here. To carry out an audit in a nothing documented environment would be exceedingly difficult and extremely costly. So assuming you're an internal audit, you go in to audit a certain element of the business. There's nothing in writing. Where do you start? also keep in mind, you can have the greatest system in the world on paper, but if people don't respect it, it's of no use. It's of little use. Okay, so let's just run down a couple of points here on documentation. Although it's not one of the 5 COSO components, it is a necessary part of an internal control system. What's possible? It is possible to have a strong control environment without documented policies, but it's unlikely to stay controlled for long, as the people who originally established the controls and operate the control structure, they leave through normal attrition. They go and get a better job, or they get the sack, or whatever. So it's for management to determine, to use their judgment in determining the extent of documentation that is needed. And the documentation and controls are needed for a variety of reasons. The documentation provides a starting point for new employees. So a new employee starts a business today, and he said, fine, okay, I've got my job description. What's required of me? And well, we'll work that out as we go along. Yeah, just follow Jim, he'll help you. Need to have policies, procedures, actions documented. Incoming employees, they don't always have the information necessary to do the job. I think I've touched on the policies. Yeah, one important point here, if you don't have the documentation, without adequate documentation, the effect of the system depends wholly on the skills and competence of the manager or supervisor responsible for performing the control procedures. What's the result? Varying degrees of performance between individuals, and that can have an adverse effect on system performance over time. So, documentation, vitally important. Cost of controls. Can't think why I put on the slide a control mitigates a risk, but in effect, that's what it does. But setting up controls, designing controls, introducing controls can be a costly business. And it's got to be considered, the cost has got to be considered along with the risk of failure and the potential impact. All I can say on this particular point is that to actually implement controls after something has gone wrong, or about to go wrong, is a lot more difficult and costly than implementing the control at the outset of a project, for example, or a new business process, or a new system. Putting internal controls into place, introduce them at the start. As the project is being discussed, the strategy is being discussed, the process of how this is going to be achieved, the risks, do it at the beginning, not at the end. Well, I think talking about the end, I think I'm very close to the end now. I want to run down just a summaries of the of what I've been talking about there, and I just put a few on the slide because there are just so many different elements. Because let's face it, risk management, internal control, governance is a fairly complex topic. I wish I could have spent more time with you, but I can't just now. Let's sum it up. Primary responsibility for the internal control system rests with the board of directors and the CEO. It's their attitude and actions that sets the tone for internal control. People are the organization. People are the organization. Therefore, people are responsible for achieving its objectives, whether they have a title of director or manager, or whatever title they have, the system is dependent upon people, and it will succeed or fail, depending on the attention people give to the process. I hope I'm not going to upset anyone when I say the next sentence. Risk management and internal control are two sides of the same coin. All organizations face risk. Whether I should add here, well, I'm going to add it in any case. Risk is managed by having in place the right controls to safeguard against the risk occurring. I don't think there's any disagreement on that. If there were no risks, controls would not be needed. Now, this may be contentious. Internal control and risk management should not be seen as something for specialists, only for specialists. The processes have to be close to ordinary managers. Do not build silos or run risk management on a stand or internal control on a standalone basis. The important qualities are cooperation and mutual understanding. Biggest challenge is the documentation. People will take shortcuts in order to make deadlines. They'll have done their job. They'll have seen no further need to sit down and write reams of paper, although it doesn't necessarily need all that. So my advice is document what you do. Unless you know how things work, you can't improve them. And without proper documentation, management has no basis for assurance of system integrity. The auditability of the system is compromised, and subsequent modifications of the system become more complicated. A business cannot survive and flourish if it's not built with the discipline of controls. The other important point here, an effective business enterprise is one integrated system. The only approach that works is to have internal control and risk management integrated into the culture of the business, and to have every officer, manager in the company accountable for making it happen. Believe me, a piecemeal approach doesn't work effectively. Never let yourself think you are finished building your risk management or control system. These things take constant care and nurturing. View the risk and control systems as evolutionary. You need a deep understanding that this is always in a state of change. You need to be able to change easily. Internal controls exist in relation to what they do to mitigate, but never eliminate risk. Business resilience, operational discipline cannot be achieved without effective internal controls. Plan effectively. Consider risk and how you will control it at each step. Internal control and risk management are fundamental elements of corporate governance, i.e., the influence of an organization exercised by the executive body. It should be integrated into the overall governance of the business. Finally, all I would say is apply high ethical standards. Ladies and gentlemen, I think that is my presentation for the day. I wish I could have done more, but thank you so much for your patience. I hope you've taken something away. I'll pass you back now to Dr. Rakesh.
Yeah, thanks, Mr. Tom, for a wonderful session. So
yes, we can.
I think we can take some questions. And Let me just take few important questions that we have come across. First question is from Mr. Mitain. How do we ensure internal controls
Sorry,
under
please,
business
Dr. Rakis, ask
continuity
me that
plans?
question again.
Yeah. How do we ensure internal controls under business continuity plans?
How do we ensure internal controls
under business
Right.
continuity plans?
Okay. As I said at the outset, the internal controls is not a separate business. It's not a separate unit. Internal controls, risk management, governance is a framework. Personally, I could not go into a company today and set up internal control my own. I need to go to the executive. I need to persuade the executive that this is what is needed and this is how to go about it. It is very, very difficult to do without the executive management supporting the initiative. If you take the enterprise risk management, doesn't matter whether you call it enterprise risk management, whatever, without the main parties buying into the program, and that's where you need to stop. You've got to get those people to buy into it, and once they've bought into it, then you can look at how you can implement and put it into a strategic fashion. But it's all to do with the objectives of the business. What risks are going to be in place, are going to stop you achieving the objectives of the business? And only the people at the top will know what those risks are because they have set the strategy. They will have said, this is what we're going to do. Now, the risk management's role, I would call my risk management in and sit them around the boardroom table, and I would say, fine, listen to this and tell us how we're going to avoid this. Now, some people have internal control managers, some have risk managers. But my experience and my view is that they're not called in when they should be. You've got to be there talking to the directors. This is where I say it's an integral part of corporate governance. And if you can persuade the directors of the importance of the internal control and risk management perspective, then you've got a very, very good chance of putting the risk management, internal control enterprise-wide. Does that answer your question?
Yeah. I think we can take next question from Mr. Kuntal. Can we say organization compliance synonyms to internal control?
Sorry, I'm missing you, Doctor.
Yeah. Can we say organization compliance synonyms to internal control? He means to say whether the organization compliance, if it is done, it is equal to internal control.
Well, again, yeah, that's a very good question. I understand the elements of compliance, and again, some companies will have a compliance officer. They have a risk management officer, and they'll have their audit committee. But compliance is fundamental. Let me give you an example. I did the work not long ago on compliance, and the company said, we want to make sure that the procurement operations, because for some reason it was a procurement role, we want to make sure that all the procurement people are compliant, that they comply with the rules and regulations that we've set up. So I said, well, look, you've got internal audit to ensure compliance. No. And you've got a compliance unit as well. Oh, no. We want to catch the problems before they get to internal audit, before they get to the compliance unit. So again, compliance is a huge topic, because when you talk in terms of compliance, I was going to put it in the presentation, but it's a
very extensive topic.
Yeah. You've got ordinary compliance with the rules, regulations of the business. Then you've got the regulatory compliance, tax, accounting, legal, human resources. So you've got all these other different areas, and they're all tantamount to disaster areas for risk, when it comes to risk. So compliance, I would include, personally, I would say compliance, risk, control all falls in under one package of governance. Without the effective governance, it's going to be difficult to change minds. And you can also bear in mind on this particular topic is the managers, the department manager there, he's there to ensure compliance, although you find it difficult to understand at times. And my view has always been, if you have a manager and you're paying him X thousand rupees or whatever a year, you can't take his responsibility away from him. Because I told one manager recently, fine, if I take your responsibility for internal controls and risk away, what if I take 50% of your salary at the same time? So again, I don't think you can, in the huge company, complex companies, chemical, oil, that kind of thing, you're always going to have a compliance department. You're always going to have an internal audit. You're always going to have the risk management department there to bring it all together. But yeah, compliance, you can set the rules for compliance, but you need, I think I said earlier, you need to have the management there, the management, the operational management. You know, I said tone at the top. Well, I think you need the tone at the middle as well, because it's those guys in the middle that can be most obstructive. It's not usually the senior management that are obstructive. It's usually the middle management that you've got to get on your side. But I don't really see a problem if you apply a bit of common sense, have some good interpersonal skills, get onto the people and say, look, what if we do this? This is what's going to happen. Now, no manager in their right mind who's have the company's interest at heart is going to turn around and say, well, no, I don't want to do that. But when you say to them, well, lots of benefits, well, no, it's a difficult one.
Okay. Yeah. I think we are running out of, still we'll take last few questions. A question from Mr. Mandirata. Could we say internal control facilitates risk management?
Could we say internal control
facilitate risk management?
No. No. The answer is categorically no. And let me tell you why I say it. Thank you again. Another very, very good question, because people get confused with risk management and internal control. Internal control's got a wider brush, of course, because it runs from the governance issue. But so does risk management. Risk management runs from the board of directors all the way down. You can't segregate them both at all. You know, the importance of risk management, that's the first step in the process, isn't it, really, when you think about it? The second process is internal control. Because once you found the risks, analyzed, measured the risk, and agreed whether you're going to take that risk or not, or whether you're simply going to mitigate it, you've got to say to yourself, how? How am I going to mitigate this? You're going to bring in controls, or you're going to ignore the risk. These are decisions for the management. And my view, I've always had the view that you cannot separate these important functions. Okay, procedures, all that kind of thing. But there's risks in ignoring the procedures, so risk management plays its part. Risk management, yeah, I always come round to the fact that risk management is just fundamentally important. But you can't have one without the other. If you have risk, you've got to control them. Mm-hmm. So two key functions, in my view, in any business, outside of the selling the goods and services and things like that, but you've got to have internal controls. And those controls are only needed where you have risks. So is it the cart before the horse, or the horse before the cart? No, there's a really good question, that one, and I think I could probably debate that for most of the day. Yes. But yeah,
we will just quickly take through the questions, and these topics are these are unending topics. Actually, you can just continue to talk on for a number of hours.
Sorry,
next question I think we can take from Ms. Rama Dahel. How to control balance between excessive and little control?
How to
control balance between excessive control and little control? I think excessive control is also bad.
Yeah, not a very good question. Excessive control can do extreme damage to the business. If you apply excessive controls, you can actually stop a lot of the good things happening in business. And no, you cannot have excessive controls. You can have control, effective management control. But once you start attempting to control everything, you're going to alienate the management, the operational managers, from one thing. Because when you think of it, how many departments are there that you would need to control? Human resources, accounting, production, sales. There's lots of areas there where human resources are not going to be looking for excessive controls. Management need the freedom to manage. Got to have the freedom to manage. And my view would be, if I'm looking at a department, looking at what that management is doing, and I think he's doing it right, in my view, I let him get on with the job, but I'd keep in touch with him. I'd go back to him frequently. How's things going today, Dr. Rakesh? Have you any problems since I last met with you? Did you do anything I said? Did you pick up any of my suggestions? I came away with a lot of good information from you. We don't need excessive controls. Anyone who puts in excessive controls will damage the business.
No, I think since we are running out of time, we will. Mr. Sanjay, you can just come in if you want to have some closing comments. Mr. Sanjay, are you there?
Yes, I am here. Are you able to hear me?
Yeah, we can hear you.
Thanks, Mr. Tom. It was a very nice session, and we are listening you for the first time. And I think you have revised some of the lessons that we have done in our risk management course, and you have reinforced some of the things which is required for effective risk management. And the key point that I understand the difference between internal control and risk management, and how does it basically integrate, leading up to the same finding, the solution of the objective. So I think it's a very a nice session, complementing our course, and hope that this will help in enhancing the understanding of risk management, because control, as you have said, is one of the ways through which you can manage your risks. So thanks again. We shall come back to you sometimes in future for one more session, or more sessions from your the experience, and maybe you can share some of your personal experiences on either on internal control or on risk management that you've gathered over the years, and share with our participants. Thanks a lot.
Thank you very much. Most welcome.
Thanks again, Mr. Tom, for sparing your valuable time and joining us at such a short notice. And thanks all the participants for attending this session. So we'll be uploading this recording maybe within a day or two. Thanks, Mr. Tom.
Thank you,
We'll
Dr.
meet again.
I can't time next time.
No issue in that. Times happens. So thank you.
Thank you very
Thanks,
much.
thanks.
Thank you.
Thank you.
Bye.
Thank you.
Bye.
Bye.
And anyone wishing to join this virtual conference on health insurance, they can send a mail at info@rmaindia.org. The registration fees is, I think, 750 plus taxes. So you can contact our department for registering. Thank you.